Chairman Powell, Fed Chair, 30 minutes away on Capitol Hill, and your equity market doing absolutely nothing going into the opening bow. Futures unchanged on the S&P and the Nasdaq, unchanged as well on the Russell, unchanged as well. You can see a theme emerging here as we wait for Chairman Powell and his comments. There's your opening bow. Switch up the board and get to the bond market. Yields not doing much either. Basically totally unchanged on a 10-year, 395.58. In the FX market, euro dollar not giving me much. We're down about a third of 1%. 106.50. Amazing to hear some of the comments from Holzmann, the National Central Bank Governor of Austria, in yesterday's session, teeing up, pushing for 4 more 50 basis point hikes from the ECB. I get it, he's an outlier, he's super hawkish, but the fact is that's going to be part of the conversation on the Governing Council later this month, with him pushing his agenda. My question is, they'll go 50, okay, will they tee up and commit to another 50 basis point hike at the same time as saying we don't do forward guidance? The whole thing's ridiculous. Crude right now, holding on to 80, we're down 0.4%. WTI $80 and about 14 cents. We are 40 seconds into the session. Your equity market opens up like this on the S&P, dead flat on the Nasdaq, unchanged. That's the theme right now as we wait for Chairman Powell, 29 minutes away. One stock to watch at the open, Dick's Sporting Goods. The company's forecast topping estimates and sounding confident it has resolved its supply chain issues. The CEO said this: as planned, we continue to address targeted inventory overages, and as a result, our inventory is in great shape as we start 2023. Abby has more. Hey, Abby.
Hey, John. Well, shareholders really rewarding the stock right now. Dick's is popping more than 5%, the best day of the year since last December. And of course, it does have to do with that outlook. They also put up a solid quarter. They saw a second quarter of same-store sales growth, that after 2 quarters of declines last year. And that, of course, had to do with those inventory issues and perhaps also the macro around the idea that last year there was expectations for a big recession, consumers slowed down, but up 5.5% in the fiscal fourth quarter that ended in January. As for the quarter that was, not surprisingly, they beat top and bottom line estimates, not by a huge margin, but there was a beat, really reiterating the idea that demand for sporting goods items, well, it is in place. And that outlook, as you mentioned, they raised it. They also more than doubled the dividend. So good things here for Dick's Sporting Goods. As for the stock on the year, it is outperforming. Right now, it after today's, actually, this is the 1-year view, up 42%. Now, Hibbett, a smaller competitor, is a little bit higher, and Big Five is down. But on the year, Dick's Sporting Goods is beating these other 2 stores, really blowing away the competition, especially after these results, John.
Abby, thanks for that. We're also watching the airlines as well. JetBlue and Spirit said to be facing an antitrust suit from the DOJ as early as today. JetBlue responding in an email to Bloomberg, writing this: we believe there is a high likelihood of a complaint from the DOJ this week. We have always accounted for that in our timeline to close the transaction in the first half of 24. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, so they anticipated a bit of regulatory pushback here. That isn't to say, though, that investors weren't a bit surprised by this. You saw that reaction really yesterday when Spirit shares were down the better part of 9%. But here at the open, a little bit of a rebound taking shape, now up about 1.3% in the first few minutes of trading. JetBlue, for its part, is up by about half of 1%. I would note that this isn't just about the Department of Justice filing suit against this $3.8 billion takeover, that they are expected to file that in federal court this week, alleging that the elimination of Spirit would increase ticket prices and decrease options for travelers. But also, the Department of Transportation is expected to begin a parallel proceeding to block the transfer of Spirit's operating certificate as incompatible with public interest. That is largely unprecedented in the modern era, John. We haven't seen the DOT use its authority to block the transfer of a certificate like that since 1978, all the way back when the airline industry was deregulated. So this is really significant here. And again, it all comes back to the availability of discount flights or cheaper flights for consumers on different routes. All of that said, though, even if JetBlue and Spirit ultimately succeed in combining, they will still make JetBlue only the fifth largest U.S. carrier based on domestic traffic. So it is still smaller than the likes of American, but nonetheless, the merger here of these two could give JetBlue more pricing power that will ultimately impact how the other major airlines have to change their prices as well, John.
Kelly, thanks for that. One to watch. You'll be covering it, no doubt. That stock is up by a little more than 1%. One call to have a look at: Evercore upgrading Delta to outperform, seeing an improving backdrop for the airlines. The analyst had this to say: fuel prices are behaving, China's reopening is a positive development, and recent pilot contract negotiations has lowered Delta's cost outlook uncertainty. S&P. The stock's flying year to date, excuse the pun. Dow are up another 1.9% in today's session. Elsewhere, from airlines to automobiles, Rivian shares under pressure after announcing plans to raise more than $1 billion through the sale of green convertible bonds. That stock is down 7.6%. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. The downward pressure on the stock reflecting that issuing convertible bonds can potentially have a dilutive impact on the shares outstanding. As our colleague Joel Levington in Bloomberg Intelligence points out, this kind of shores up the liquidity story around Rivian, which ended the fourth quarter with around $12 billion of cash, cash equivalents and unrestricted cash on its balance sheet. But investors have had concern about the rate of burn that this company is going through as it ramps up production. The green angle also interesting. Of course, this is a maker of electric vehicles with longer-term, broader ambitions around the transition to clean energy, but it does add to an existing debt pile, these green convertible bonds due in 2029. The issue of converts is kind of interesting to me, right? For investors, this is an opportunity to get an interest payment with, the right but no obligation to convert to shares. For Rivian, this is taking advantage of a cheaper means of raising funds amid higher interest rates. But look to the equity story, right, and that share performance on a 12-month basis or more. You kind of get why they might do this, John, instead of just going directly to the equity market. It's an interesting situation for Rivian, and they're kind of following others in this space. I'm thinking, of course, of Lucid that look to the same mechanism.
Looking forward to your coverage on the tech show later, Ed. I just wanted to squeeze one in just to follow up to our conversation earlier this week. The price cuts again at Tesla. How are people responding this time around?
Yeah, look, earlier price cuts in the year unlocked pockets of demand. What I would say about the Model S and Model X is very low volume production, 100,000 units just out of Fremont, and they're still very expensive. There's an interesting debate about the rationale behind it, given that they're still outside the scope in some sense of the IRA tax credits. But, this is a lever that Tesla's using. Other automakers are following suit, and the outperformance of the shares year to date to some peers suggests that analysts in the street see it as a useful mechanism to find those pockets of demand, particularly here in North America.
Tough year last year, massive year-to-date gains this morning, down about 1%. Ed, thank you, sir, as always. The broader market looks like this, 7 minutes in, unchanged on the S&P, slightly firmer, stronger, higher, positive on the NASDAQ, up 0.2%. Tom Kennedy at JP Morgan has this to say on the bond market. We expect the Fed to keep hiking rates by 25 basis points until payroll growth slows materially to less than 100K monthly payroll gains. We expect that criteria to be met as we approach mid-year. Tom, I'm pleased to say, joins us right now. Tom, great to catch up with you, sir, as always. 23 minutes away from Chairman Powell. If I looked at the January data alone, reported in February, I'd look at that and say we are not sufficiently restrictive. When you look at the complete picture, Tom, are we?
Good morning, John. Yeah, I do think we are restrictive. Powell has used this word, the disinflationary process, and to some degree, John, the market has said, oh, wow, this is the immaculate disinflation we've been expecting. But really, when I hear Powell talk about that, I think he's really describing the road to recession is about halfway paved. What I mean by that is we're getting every indication that rates are restrictive in America, and the things that I look at, number one is the housing market. You have this rare situation where construction completions are higher than construction starts. And you can imagine if you're a builder and you're completing 10 jobs and you're only rolling crews over to maybe 8 jobs, layoffs will happen. Second is in the capital investment or corporate CapEx space. Capital availability is quite low and suggests CapEx will continue to deteriorate. And then lastly, you're finally starting to see auto and credit card delinquencies pick up, albeit very low levels, John, but there's good reason to believe the disinflation process is well underway because we're getting firm evidence that higher interest rates are restrictive here.
So, Tom, when you look at a downturn, anticipating one, it's the 3 Ds, depth, duration, dispersion. Can we just deal with the third D there, dispersion? Are you seeing that weakness spread as the months go by?
Yeah, I think there's this road to recession, or really road to layoffs, John, is non-linear when the Fed is tightening rates. Housing and tech are very quote-unquote interest rate sensitive. Construction and housing, I think, is obvious when you have a short mortgage cycle. But for tech, we had a decades-long equity availability of capital, and that's been shut down by the Fed as well. So those are going to feel the impacts first. But John, if we're sitting and Powell and team at the Fed, what do they really want? They want more broad-based layoffs. I think the sectors we should be looking most at are construction, manufacturing, and unfortunately finance jobs to see evidence of progress along that roadway.
Claims, as you know, 190. The last jobs report, 517,000. Unemployment, 3.4%. The estimate for this coming Friday, I've got the estimate right now at 224 in our survey. That's a moving target, of course. That's the median estimate in our survey so far. More estimates will come in, but let's go with the 224. You're looking for sub 100K, in your words, as we approach mid-year. Tom, what is it about the glide path that you see? What's important about mid-year?
I think what's important about mid-year is you'll have a long duration period, almost a year, of positive real interest rates and restrictive financial conditions that take time to move through the economy. John, this week, expecting 200,000 jobs added is really a continuation of the slowdown in job growth we saw in the back half of last year. It does suggest January was the anomaly. I think there's good reason to think that too. It's very rare historically to see 500,000 jobs added in a month. I think we naturally all should have a statistical asterisk on there. But I think the deterioration is just a continued roll through of slow CapEx, and companies do billions of dollars, like JP Morgan, billions of dollars of CapEx every year. If we're slowing our CapEx, revenues for others are starting to slow. We're in step 3 already. This is step 3 of the roadmap. And what am I really describing is a world where earnings deteriorate. Q4 of last year, average S&P 500 earnings are down 5%. This is underway. I think it will just take more time. And then step 4 is where you actually see businesses defend their margins. I'm expecting that around mid-year, John, but this resiliency piece that you're highlighting may push that out a little bit, but doesn't mean it doesn't happen.
We're having a conversation about recession at the same time David Solomon speaking at an event over at Goldman Sachs. It's an RBC conference. The Goldman Sachs CEO says a chance of a soft landing is meaningfully higher. Tom, you have to confront both sides of the debate each and every time. You also have to look at the menu in fixed income at the moment, 2s out to 30s, and make a point that you want to advocate for purchasing somewhere across the curve. Tom, as you put it all together, the debate, arguments on either side, look 2s out to 30s. What do you like on that yield curve right now?
I like to have some sort of duration for my clients because, John, first and foremost, they don't have much of it. I want them to be adding and locking in yields here because I do see those rates as restrictive, and by definition, if they are restrictive, they'll go down in the future. It's a simple conversation with a client, John. It starts like this. Do you think a 5% T-bill is attractive for your portfolio? Unanimously, I see yes. Okay, well, why wouldn't you want to lock that in for, say, 5 years? And it's just a way to start to engage them of what do you want your money to do for you? And finally, John, for the first time in 15 years, we can help clients reach their portfolio goals with less risk. So ultimately, I want them to be adding duration, and in our community at JP Morgan, it ends up looking like a 5-year municipal or investment grade bond.
And maybe even looking for 285 on a 10-year by year end. So let me take that argument for bonds. Tom, if that's an argument for a 10-year, is that an argument against equities?
I don't know that it's necessarily so John, let me say no. You can have equities for your appreciation and bonds for your confidence in your portfolio total returns. So you can own both. I think for the marginal dollar spent here, it's fixed income far and away. The earnings yield on the S&P 500 is about the same as a 12-month T-bill. When you show that to a client, well, the S&P has some risk and T-bill really has negligible risk. So how can it be marginal dollar spent in this risk bucket? So I just think you have to give people this what's in the price concept and let them see the value for themselves.
Tom, just a final one. The chairman in about 17 minutes' time. Members of Congress do watch this program, and if someone from the Senate Banking Committee is watching right now, or maybe a member of the House Financial Services Committee for tomorrow, what's the question you'd like them to ask?
I want Congress to ask the question about confidence in the progress. And I would like to see Powell really emphasize this disinflationary process being underway as progress towards the layoff cycle, not progress towards immaculate disinflation.
Politically, let's see how that argument goes. Tom Kennedy, thank you, buddy, over at JP Morgan. Appreciate it, as always. About 15 minutes away from hearing from Chairman Powell. Coming up on this program, another round of tech layoffs.
Focusing on the bottom line, creating efficiencies, those are value company techniques to create shareholder value. And I think that's what Meta's being forced to, but overwhelmingly the tech sector is overhired. There's probably more redundancies coming from all of the big cap tech going forward.
Meta is gearing up to make another move. That conversation up next.
Companies, the stock market rewarded them for growing, attracting users, not generating profit necessarily, and I think Facebook or Meta has acknowledged now that it's more of a value company than a growth company, and focusing on the bottom line, creating efficiencies, those are value company techniques to create shareholder value, and I think that's what Meta is being forced to, but overwhelmingly the tech sector is overhired. Basically, to achieve that growth that the market was rewarding, there's probably more redundancies coming from all of big cap tech going forward.
Meta planning a fresh round of layoffs. Bloomberg reported the company is looking to cut thousands as soon as this week. This coming on top of a 13% reduction to its workforce back in November. The CEO, Mark Zuckerberg, saying at the time, "I view layoffs as a last resort, so we decided to rein in other sources of cost before letting teammates go." Overall, this will add up to a meaningful cultural shift in how we operate. We'll roll out more cost-cutting changes like this in the coming months, and here we are in the month of March. Ed Ludlow, you helped break this story. Can you help explain to us where these job cuts are going to drop across the company?
Yeah, broadly, what we're learning from sources is that director and vice president level staff have been instructed to draw up lists. And as you said, Jonathan, those layoffs could come in the next week as those lists are finalized. What we know from one source is that Mark Zuckerberg himself is due to go on paternity leave. His wife is expecting their third child. The hope from those management level staff is that those lists are finalized and those layoffs conducted by the time that happens. There is also a financial target that we're told, and that's interesting because the context here is the blow to the pandemic era, right? And one gauge that we've been tracking is the additional units of revenue added per additional headcount over the pandemic period. If you stack Meta alongside its mega cap tech peers, Meta's pretty firmly bottom of that pile in terms of the new revenues they were able to add by growing staff in the pandemic era. We know that they've added subscription, a level of subscription tier for some of their products. I reported last Friday, John, that the impetus for cutting prices on the AR, VR headsets was simply a lack of demand. They're not able to sell any. So there's a lot of pressure to make this happen, and what we're hearing is that it will happen soon. It will be pretty broad-based. I'm told by one source those original 11,000 cuts at the start of the year were very forensic, very planned. What I'm told this time around is it's more of a sledgehammer approach. They have to meet these targets. They have to make these additional layoffs, which are separate to the 11,000, separate to that management flattening, and it will be strong.
What a change. What a change for this company in the last 12 months. Ed, thank you, and tremendous reporting, sir. As always, thank you, buddy. Thinking about these tech cuts, still not showing up in the broader labour market at the moment. Jobless claims still in and around 190. Looking ahead to payrolls, if you missed that number a little bit earlier in the programme, sneak peek of payrolls Friday, the estimate so far in our survey, still north of 200,000, 224,000. The previous number was just a blowout 517. This is what Chairman Powell has to confront in about 9 minutes' time. He's got to look for the data on Friday and payrolls, and then CPI on the 14th drops in the quiet period ahead of the Fed meeting on March 22nd. He's going to face 2 days of questioning from lawmakers on Capitol Hill. 10 a.m. in front of the Senate Banking Committee. That's about 8.5 minutes from now. Then on to tomorrow at 10 a.m. Eastern Time, again in front of the House Financial Services Committee this time. Mike McKee's back with us for a final word. Mike McKee, looking ahead to this one, your focal points, what you are really, really looking to narrow down on with Chairman Powell later, what are they?
Well, I'm going to pick one thing, John, and that is why hasn't unemployment risen even though the Fed has raised rates by so much? You talked about jobless claims not moving. Will they start to move soon because people who have gotten severance are no longer getting it and they can file for claims? Will companies suddenly start to lay people off? That'll be an interesting question to get Powell's answer to.
Mike McKee, looking forward to it. 8 minutes away from that testimony on Capitol Hill. We will, of course, bring you those headlines and that testimony right here live on Bloomberg TV and on Bloomberg Radio. Just like we were going into the open, coming out the other side, your equity market is going nowhere. The S&P 500 totally unchanged, on the Nasdaq positive by about 0.2% or so. Yields come in a single basis point at the front end. Your yield now 487 on a 2-year, on a 10-year, just short of 395, down a single basis point there at about 394-ish. Let's get you some sector price action. Here's Abby.
Well, once again, John, we're looking at anemic volume, but the S&P 500, as it flips ever so slightly higher, up for a fourth day in a row, potentially the best streak since the middle of January. It's all about the mega cap tech sectors that are leading today. Communication services. Actually, we have utilities sneaking in there. Consumer discretionary higher. Dix, I should mention, hit a record high earlier. To the downside, though, we have energy and materials. And over the last year, you were mentioning those David Solomon headlines over the last month, I should say. Banks, interestingly, down, even though yields are sky high. John, this could have something to do with banks now having to give money out on deposits.
We'll see if that develops just a little bit more. Finally getting some interest in the bond market, some real income. Up next, your training diary, Chairman Powell, 6 or 7 minutes away. So these are the scores going into Chairman Powell. This is how the stage is set. Equities totally unchanged on the S&P 500 on the session, on the Nasdaq positive by about 0.25%. In the bond market, not too different. On a 2-year yield, we're down just a single basis point. On a 10-year, similar move. That's the price action. Let's get to that trading diary. Top of the hour, Fed Chair Jay Powell kicks off 2 days of congressional testimony. ADP jobs numbers, monthly jolts, that comes out tomorrow. President Biden releasing his budget proposal on Thursday. Governor Kuroda's last BOJ rate decision on Friday. And finally, the main event, it's payrolls coming up on Friday. Before we get there, it's the chairman of the Federal Reserve, 4 minutes away.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, March 7th. Here are the top market stories we are following for you at this hour. It's Powell time. The Fed chair is about to testify before the Senate Banking Committee. What clues can he give on the path of monetary policy when there's a lot of data he doesn't have yet? Markets, though, wait with bated breath. Stocks not doing much. Treasury yields aren't either. Traders instead holding off until they can dissect Powell's every word. And the labor puzzle. The tech layoffs continue as Meta Platforms plans a fresh round of job cuts affecting thousands of employees. Friday's jobs print will show if the weakness has expanded beyond that sector. From Washington, I'm Kaylee Lyons with my co-host in London, Guy Johnson. Alex Steele is on assignment. Welcome to Bloomberg Markets. Guy, it's Powell time.
It is. I'm just looking at a live shot, actually. Elizabeth Warren looking very animated in advance of this hearing. It'll be interesting to hear what she has to say a little bit later on. Clearly, we are waiting for Jay Powell. He has just sat down, as you can see. Maybe he's got up again. Needs a new chair. There we go. Sat back down again, getting himself nice and comfortable. It's going to be a marathon session, Kayleigh. The market is expecting flatteners, i.e. for him to be maybe a little bit more hawkish. We'll see whether that's delivered. But as you allude to, the key question here is how quickly will the data date Powell today? We've got jobs tomorrow. We've got payrolls coming up on Friday. We've got CPI coming up next week. There's lots and lots of things that are about to date what is happening on Capitol Hill today. So let's kick it around. Let's get a sense of what is happening here and bring in our Bloomberg Roundtable. Joining us, Mike McKee with you in DC, Ira Jersey, our rate strategist, joining us, Anne-Marie on the politics, Ed Ludlow here to talk about jobs, particularly jobs being lost at Meta. Mike, let me start with you first of all. If you were to put a date stamp in terms of the data next to what Powell is going to say today, what would it be? What vintage Powell are we going to get here today? Is it the last payroll report? Is it the ISM services number, which showed that incredible strength? How should we think about what Powell is going to be saying today from a data point of view?
I would go back to the December 14th Fed meeting. We have the Powell headlines out now. We know what he's going to say in his prepared remarks. Basically, what he has said before in the past, that the Fed is prepared to do whatever it takes to bring inflation down, needs to do that. They will speed up rate hikes if they need to. There is some reversal of the recent softening that has taken place, but it could revert in the data that is to come, and it will take some time for the full effects of the Fed's tightening to make it into the economy. So at this point, it looks like the Fed is status quo, which is kind of the message that Powell has been expected to give. Don't expect a whole lot out of him in terms of specifics, although he does say that the economy's strength suggests the peak rate could be higher than previously anticipated. Remember, the median was 5.1% at that December 14th meeting. 10 members of the Open Market Committee saying 5.1%, but 7 had said up to 5.5. So wouldn't take much to move that higher. And given the data that we've had so far, you think they might do that, although we still have jobs on Friday and CPI next week.
Well, and with that in mind, it raises the question of how hawkish he really can be when he doesn't know what the data is going to tell him. But could it create a problem for the Fed if he isn't hawkish enough, if he doesn't say enough today?
Well, ordinarily you would think that would be the case, that it would affect the markets in that sense. I suspect that whatever he is going to say today will have a very short shelf life, because the markets are going to reprice on Friday, and they're going to expect the Fed to react to that data on Friday and to their repricing. And then, of course, we've got CPI next week, which will really be dispositive. If CPI comes in hot, then the Fed is definitely going to be leaning to the 50 basis point mark, and they'll probably be marking up their terminal rate to over the 5.1%. If both revert somewhat, and the forecast for jobs is 234, I believe, at the moment, then the Fed is probably going to stick to the 25 basis point move at the March 22nd meeting, and it'll be a closer call in terms of the dots, how much higher they go.
All right, Bloomberg's Mike McKee, great to see you down here in Washington. Thank you so much. And I would note that the bond market is reacting to these initial headlines out of Powell. The 2-year Treasury yield right now up 7 basis points to 4.96%. So let's get more on that now. Ira Jersey of Bloomberg Intelligence, who looks at rates for us, is joining us now. Ira, so it looks like maybe there was indeed room for a hawkish surprise, even though we have seen such a dramatic repricing in recent weeks.
Yeah, it was. I think that the way that I read the opening remarks, they are a little bit more hawkish. I think the market reaction with the bear flattening of the yield curve is, it is appropriate for what Powell said. The fact that he hit on services, core services prices continuing to move higher, and there's not seeing any disinflation there. I think hitting on home on some of the
My name is Jim Rickards. I'm a former advisor to the CIA, Department of Defense, and the White House. than wage cost pressures, unquote. The Fed, understandably, the Fed can't force corporations to change their ways or rewrite the Wall Street business model on its own, but the Fed can talk about it. High interest rates, falling wages, increasing unemployment are all hallmarks of failed policies that end up helping Wall Street, the largest corporations in the country, the wealthiest people in the country. Because let's be clear what we're talking about when people use the economic speak that can cloud this conversation. Cooling the economy means laying off workers. Lowering demand means workers get fewer raises. Of course there are times when the Fed must act. We can't allow inflation to become entrenched. We've seen encouraging trends that isn't happening. And there are other ways we can bring prices down instead of lowering demand. Again, making people poorer, laying people off, denying worker raises. We can speed up and strengthen our supply chains. We can bring critical manufacturing back to the U.S. We can rebuild our infrastructure. It's what we're doing with the CHIPS Act, with the Inflation Reduction Act, with the bipartisan infrastructure bill. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned the corporate offshoring would do to our economy. Look at East Palestine, Ohio, a community that Senator Vance and I have visited a number of times recently. America learned about this small town last month when a Norfolk Southern train derailed and spewed hazardous material into this community. East Palestine is more than just a disaster headline. Columbiana County was once the center of American ceramics manufacturing, at one time producing 80% of ceramics of dishware in this country. One county produced 80% of it. When I was there last week, I was talking to the sheriff at the 1820 Candle Company. He was talking about how the last one closed just a few years back. Like so many industries, these jobs moved overseas, and we know why. The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one-third of its workforce in the last 10 years. Then you're surprised with these derailments? It's the same reason corporations now keep prices high even as supply chains stabilize. It's the Wall Street business model. Chair Powell knows that. I know that. My Republican colleagues and Democratic colleagues know that. It's a Wall Street business model. Quarter after quarter, corporations are expected to cut costs at any cost. They skimp on safety. They move production overseas to countries where they can pay workers less because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power in this economy. Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities, more options, even in places that haven't seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity for that dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, two more things that affect your job. It's not just monetary policy that threatens American pocketbooks. Some of my colleagues have threatened the nation's full faith and credit by holding the debt ceiling hostage for partisan politics. Instead of paying our bills on time, they're essentially threatening all Americans. The Fifth Circuit's Consumer Financial Protection Bureau ruling could also cause unimaginable instability and chaos for families, for consumers, but also, as the chair knows, for a financial system. The Fifth Circuit is Wall Street's, no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is unconstitutional. If the Supreme Court upholds the Fifth Circuit's ruling, it will not only devastate CFPB, it will threaten the independent funding of many other federal agencies, including the Federal Reserve. I look forward to today's hearing, how the Fed will balance its dual mandate and continue to promote an economy where everyone who wants a good job can find one, an economy that works for everyone. Senator Scott. Sorry.
Fine. Good morning, Chairman Powell. Sitting here, looking at my prepared remarks, thinking about, there's an opening coming where Vice Chairman Brainer's moving on. I think it's really important for us to make sure that all the information that we need in order to make a good decision on the next NOM that we have in a timely fashion. So I would really implore the chair to make sure that happens, that every question, every questionnaire that is asked from the person, we get. Every member of this committee has their questions answered in a timely fashion, and that the staff has their answers in a timely fashion. Listening to Chairman Brown, I thought to myself, fascinating, truly fascinating. I concluded that, well, I know Chairman Brown pretty well. I am sure he is sincere in his rant. But let me just say this. Spending and printing trillions of dollars, caving to the radical left in this country, seeing policies posited and then implemented that led to the worst inflation in 40 years, seeing our inflation at 9.1%, seeing American families struggle because of the weight of the government on their shoulders, seeing the devastation from South Carolina to Ohio. It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute devastation caused by their out-of-control spending is remarkable. Remarkable. To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in to cool the economy. Well, the definition of cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single-parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices devastates single mothers around this country. For seniors on fixed income whose savings are being depleted with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers of the government. There is a better way. The better way is to trust the American people. And when you do so, we don't have to have the Fed come in and raise interest rates so high to quell the challenges in our economy so that today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending of our friends on the other side of the aisle. I'm sure I do not have time for my opening comments, but I will say without any question, as I look around the country and I ask myself, how devastating is it that today it costs $433 more than it did a year ago? The answer is it is a crisis. when the average family in our country just a couple of years ago didn't have $400 in their savings for an emergency, to have prices go up by this amount, it's devastating. To have a conversation about rents around the country, looking at the inflationary effect and the absolute devastation of a snarling supply chain that we haven't seen in my lifetime, run by my friends in the progressives. Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches that you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals and authorities, and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy maker. Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
You now have 4 minutes and 12 seconds.
yes, I knew the chairman would dock that from my time, and I appreciate you doing so
With a sense of humor.
with a great humor. Great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing Vice Chair of Supervision Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Speaking of illuminating, thank you, Senator Scott.
Yes, sir.
I
Thank you for allowing me to use this.
Today we'll hear from Chair of the Federal Reserve, Jerome Powell, on monetary policy in the state of our economy. And I don't expect Chair Powell to weigh in on the mini debate we just had, but I think we all know that the debt increase was much larger under President Trump and a Republican Senate than it has been since. Chair Powell, thank you for your service and your testimony today.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer-run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remained very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chair. There are 23 of us on this committee. Almost everyone will be here today. I ask each of us to stay as close to the 5-minute mark as we can because we have votes at 11:30. So thank you all for your cooperation. Chair Powell, thank you. Job growth is strong as unemployment remains historically low. You might not know that from the opening statements. Many drivers of inflation, corporate greed, rising inequality, supply chain disruptions, Russia's bestiality, if you will, in Ukraine, won't get better because of interest rate increases. Every indication is that this post-pandemic economy is different. Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
Thank you, Mr. Chairman. So we've been aware since the very beginning and have discussed this publicly on many occasions that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war which had significant effects on commodity prices a year ago. So all that is different. There are also, though, some similarities. There is a mismatch between supply and demand. You can see that in the goods sector still. You saw it in housing prices going up over 40% since before the pandemic, and you see it in the labor market where we have 1.9 job openings for every opening, for every unemployed person. So we're well aware that this particular situation involves a mix of cycles of forces, not all of which our tools can affect, but there is a job here for us to do in better aligning demand with supply.
Okay, understanding you have limited tools to address inflation, and our conversations in the past show my concern about continued rate increases that may not actually address the root cause of inflation. They hurt workers, and many of us contend we can't follow the same old playbook. Next question. Last year, 3 banking regulators issued proposed updates on the Community Reinvestment Act to account for changes in our banking system. My question is, does the Fed remain committed to work with FDIC and OCC to finalize a CRA rule, and when will that rule likely be finalized?
Yes, we do remain committed, and I believe we are in broad agreement with the other 2 agencies on the revisions to the rule. So now we're in the process of writing all that down, and that'll take some time. And then after that, of course, it will come to the Board of Governors for a vote, and that'll involve briefings and discussions. And I can't give you an exact date, but
as quickly as possible.
Yes, but it will be some months.
Okay, thank you. Banks weathered the shock of the COVID-19 shutdowns mostly because of the fiscal response provided by Congress. We now see a spike in loan delinquencies, an increase in overall risk. Banks are again plowing billions, as many other corporate leaders, always defended by people on that side of the aisle, into stock buybacks, which makes me concerned that if there's a downturn in the economy, banks could end up with too little capital. That's why I'm worried about any potential rollbacks of safeguards or regulations. Can you assure me that the Fed will keep capital requirements strong and exercise more long-term forward thinking than corporate CEOs that seem to be focused on the short term?
I can assure you as to the first part that we'll keep capital requirements strong.
I didn't expect you to comment on give me an opinion about you're looking more forward than companies that look at the short-term benefits of stock buybacks. Mr. Chair, when you last testified, I asked you about the risk posed by crypto assets, stablecoin, the Fed, and other regulated possibilities. How's the Fed evaluating the risks of crypto-related activities by your supervised institutions?
So this is something we've been quite active in this area, and I'll say that we believe that innovation is very important over time to the economy. We don't want to stifle innovation. We don't want regulation to stifle innovation in a way that just favors incumbents and that kind of thing. But like everyone else, we're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud. We see a lack of transparency. We see run risk. Lots and lots of things like that. And so what we've been doing is making sure that the regulated financial institutions that we supervise and regulate are careful, are taking great care in the ways that they engage with the whole crypto space, and that they give us prior notice. And we've issued, along with the FDIC and the OCC, a number of issuances of notices to that effect.
Thank you, and I will close with this. I've long pushed for the Fed to prioritize workers and for the leaders of the Fed to reflect the diversity of our country. We've made progress, but our work is not done. We have a new opening. Understand, it's not your job to appoint the new Fed member. We have a number of upcoming vacancies at the reserve banks. I support Senator Reid from Rhode Island, Senator Menendez from New Jersey, and other colleagues who are pushing for more diverse voices at the Fed. Senator Scott.
Thank you, Chairman. Obviously, the chairman and I both have strong passions about the challenges that we face as a country. The one thing that I do believe that we agree on is the importance of having a strong capital markets as it relates to making sure that Americans have the ability to continue to grow their businesses and to solve their challenges. And frankly, I hope that we get there. Building on the same comment that the chairman had around capital standards is where I'm going to go with my thoughts today. When I think back on these last few years, it's hard not to recognize the extraordinary efforts our financial institutions of all sizes, frankly, undertook to administer a program like the PPP, all while weathering a shutdown of our global economy. I welcome your thoughts, but from my viewpoint, our banking system was resilient. Our financial institutions stepped up and delivered aid to support families and businesses every single day. That's why Vice Chair Barr's broad comments around holistic review of our capital trouble me so much. We should be laser focused on our economy and addressing the needs of everyday Americans trying to forge a new future and helping them open the door to opportunity. As you and I both know, capital and its quality must be continually scrutinized, but increased capital does not necessarily provide an increased benefit, and requiring banks to hold capital that is not risk-based and appropriately tailored to a bank's size, scope, and activities can cause more harm than good. At a time of record inflation, where everyday needs are more expensive, we should not be pursuing actions that are harmful. Rather, we should be supporting the engine of our economy, small businesses. While I remain greatly concerned by the Vice Chair's comments, I am hopeful that you will ensure this review is appropriate, keeping the impacts on our banking system front and center. We must promote and further the growth of our economy and thereby our people. Anything less should be unacceptable. To that end, will you commit that any ongoing capital review by the Federal Reserve will follow the law and that any follow-on regulatory proposals will be risk-based and tailored to an institution's activity, size, and complexity, and not a one-size-fits-all?
Yes, I can easily commit to that. You know, we're very strongly committed to tailoring, and that'll be, I can say that anything we do will reflect tailoring, which is a long-held principle for us and also now a requirement in the law.
Yes, sir. Thank you very much. 2 weeks ago, I sent a letter with Chairman McHenry to Chair Gensler regarding the SEC's climate disclosure rule, urging him to rescind his proposal and reminding him that the SEC is a market regulator, not a climate forecaster. Much like Congress designed the SEC to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation, and not to advance progressive climate change policies, Congress designed the Federal Reserve to promote price stability and maximum employment, not to play politics. To that end, I find worrying the Fed's announcement of recent actions to consider climate-related scenarios, coupled with remarks by the Vice Chair of Supervision, as attempts to incorporate broader ESG policies into the financial services system. Banks have and continue to account for weather-related risks in their risk management, but efforts that attempt to predict climate change far into the future fall outside the scope of their authority. Importantly, the level of speculation required in these models should highlight their arbitrary and capricious nature. At a time when our economy is suffering from historically high inflation, I expect our central bank to focus its time and resources on bringing inflation down, not on policy outside of its mandate. I noted in my opening statement a recent speech that you've given about the state of the Fed and how you should resist the temptation to broaden its scope and to address social issues. Do you agree that the Federal Reserve does not have the authority or statutory direction to use its monetary policy or supervisory tools to wade into the ESG or other climate policies?
I do. As you know, there's a tightly focused role that we do have that I believe that we have, but I would agree with your statement.
Yeah. Mr. Chairman, I have 20 seconds left, but I'm going to defer because of my earlier question to my opening statement.
Thank you, Senator Scott. Senator Menendez is close, but not here yet. So Senator Rounds. Oh, okay. So, but nice try.
Yes, sir. Whatever you say.
Thank you, Mr. Chairman. Mr. Mr. Chairman, first of all, welcome. It's always good to have you in front of our committee. And as you know, both core and headline inflation have remained persistently elevated. And over the past 12 months, real average hourly earnings fell by 1.8%, about 4% since President Biden took office. To make ends meet as prices increase, more Americans are leaning on credit cards. At the end of 2022, credit card debt hit a record of $930.6 billion, an 18.5% spike from a year earlier, and an average credit card balance rose to $5,805. Over the past year, the Fed has acted aggressively to tame inflation, and yet we are still seeing price increases. As we've discussed this several times, but I recognize that it's been an ongoing discussion, but I believe that this further proves that we have long been feeling the effects of a policy-induced inflation resulting from decisions by the Biden administration, primarily cutting off the resources necessary to improve and increase domestic energy production. I continue to be concerned that if you attempt to use the tools that are available at this time for the Fed, then I believe that we're going to have a challenge of not being able to address specifically the challenges brought out when you have a policy is promoting higher prices with regard to energy, as opposed to what you're trying to do, which is to bring down the total overall cost. And I just wanted to ask, I guess, and you're going to think this is something that we've heard before, but do you believe that you currently have the monetary policy tools to actually reduce inflation? And I just put it in this perspective. In January of 2021, the CPI was 1.4% when the Biden administration began. In January of 2022, and this is before the Russian invasion of Ukraine, CPI was at 7.5%, 7.5%. Today, March of 2022, CPI is 8.5%. Wouldn't it be fair to assess that a lot of the policy or the inflation that we've seen here may very well be due to policy decisions by this administration?
Senator, not for us to point fingers. Our job is to use our tools. You asked whether we have the tools to get this job done, and we do over time. There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
In other words, you've got a limited number of tools available to you, and the limited number of tools that you have are designed to impact simply the reduction in prices and so forth, and yet if there are competing interests out there that are pushing prices higher, you don't have the wherewithal to decide one tool versus another based on whether it's policy-induced or whether it is a matter of a shortage in supplies from outside or whether it's war-related.
That's right. Our tools essentially work on demand, moderating demand, and so that's what we can do.
So if there were policies in place that actually help to reduce inflation, in other words, and by that I'm just going to look at energy alone just as a good example. If policies were in place that were actually allowing energy prices to come down in the United States, then you would have less of a need to use the very blunt tools that you do have right now with regard to increasing rate increases. Is that a fair statement, sir?
In a sense it is, but I would just say on energy,
I'm not trying to get you to a policy discussion with what the president's doing on his energy policy. I just want to make it clear that you have to respond to what's in front of you, and it doesn't matter where the inflation is coming from or what's driving it up. You're simply trying to bring it back down to that 2% number with the only tools that you've really got.
Yes, but I will say on energy, energy has tended over time to fluctuate up and down, and it's not mainly affected by our tools. So the things we look at are really things that are tightly linked to demand in the U.S. economy. Those we can affect.
And I think just the fact that you've been increasing interest rates, and yet inflation continues to ride up, would suggest, just as you've just indicated, that when you have high energy prices, it's tough to impact that part of it with the monetary policy that you've got available to you.
So we focus on everything, but we also focus on core in particular, which doesn't include energy prices. And what's happened is core inflation has come down, but nowhere near as fast as we might have hoped, and it has a long way to go.
Thank you. One last question. Last June, Vice Chairman of Supervision Michael Barr testified before this committee that he would defend the use of the aggregation method as an alternative approach to the insurance capital standards, the ICS, proposed by the IAIS. As the final compatibility criteria set to come out later this year, can you confirm that you share Vice Chair Barr's views on this AM?
I will confirm that, but I'll have to get back to you on the status of that.
Okay, thank you. Thank you, Mr. Chairman.
Thanks, Senator Rounds. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Mr. Chairman, I want to take this moment to remind my colleagues that there are more than 62 million Latinos that call the United States home. We are the largest minority group in the country. We account for nearly 20% of the United States population. We contribute almost $3 trillion in GDP. Yet Latinos have no representation in the Federal Reserve's leadership. In the 109-year history of the Federal Reserve, there has never been a single member of the Board of Governors or regional bank president who has the lived experience of being Latino in the United States. And in practice, that means that the voices of nearly 1/5 of our country's people are repeatedly drowned out when the Fed is making critical decisions on economic policy. Decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. Right now, the Biden administration has a clear opportunity to make history with its next nomination to the Board of Governors. It has identified a number of highly qualified Latino candidates who have dedicated their careers to the fields of economics, who are committed to the Fed's dual mandate, who will preserve the independence of the central bank. The administration has rightly nominated and advocated for a number of diverse candidates with similar qualifications, both at the Fed and elsewhere. But despite having 5 opportunities over the past 2 years to nominate a qualified Latino economist to serve at the Federal Reserve, this administration has repeatedly chosen not to. Representation, or lack thereof, does not happen by accident. It is a choice, and I hope the administration makes the right choice with this nomination. Mr. Chairman, would you say that it is a truism that the United States dollar is the reserve of choice in the world?
Yes, I would.
And that brings us enormous benefits, does it not?
Yes, it does.
Now, 12 years ago, a Republican House brought us to the brink of defaulting on the debt for the first time in history of this country, jeopardizing our credit and the world economy. I'm getting a sense of déjà vu because, once again, Republicans are recklessly demanding draconian spending cuts to programs that hardworking U.S. families rely on in exchange for allowing the Treasury Department to pay for spending that Congress, including most of them, have already voted to authorize. If you want to talk about spending cuts, it seems to me that the budget is the time to do that, but not to put the full faith and credit of the United States at risk. Chairman Powell, can you talk about the catastrophic damage a debt default would inflict on the economy?
So I guess I will start, if I can, by saying that these are really matters between the executive branch and Congress. We do not seek to play a role in these policy issues. But at the end of the day, there's only one solution to this problem, and that is Congress. Whatever else may happen will happen, but Congress really needs to raise the debt ceiling. That's the only way out, in a timely way that allows us to pay all of our bills when and as due. And if we fail to do so, I think that the consequences are hard to estimate, but they could be extraordinarily adverse, and could do longstanding harm.
Well, I think that's a mild statement of what would happen. I understand. I didn't ask you to engage in the congressional executive branch roles. I asked you about the abstract question of what happens if you have a debt default. Isn't even this constant fight putting into question the possibility that the United States will not honor its full faith and credit have consequences within the economy?
In principle, it could. I think markets tend and observers tend to watch this and tend to think that it will work out, and it has in the past worked out. So it needs to work out this time too.
Now, seeing your testimony before the committee, Is it fair to say that you'll do whatever is necessary to tame inflation?
We serve a dual mandate, and we will do what we can, everything we can to restore price stability while also serving maximum employment.
And primarily that means additional rate increases, would it not? What other tool do you have?
That's what we have. The balance sheet, the shrinkage of the balance sheet will continue too, but it's principally rate hikes.
So the question is, when does that part of doing anything necessary to tame to tame inflation, come into conflict with your other mandate of maximum employment?
Not now, when we have the lowest unemployment in 54 years, and where we have a labor market that is extremely tight, extremely. So, but that time could come, but it really isn't now, where we're very far from our price stability mandate, and in effect, the economy is past most estimates of maximum employment.
Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Kennedy of Louisiana is recognized. Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Thank you to you and your team for helping to save the economy during the pandemic meltdown. For what it's worth, I'm generally supportive of the actions of the Fed right now, and I'm not going to ask you today to blame anybody. When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. But so, if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more, that stimulates the economy even more, does it not?
At the margin, yeah.
Okay. If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget.
All right, let's try to unpack this then. I'm not trying to trick you. You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
There are a lot of
I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
All right, let me put it another way, okay? The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate is 6.4%, and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again, blame anybody. But if history is right, unless you get some help in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight. But the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact? Please answer.
It could work out that way.
Okay. Sir?
It could work out that way.
Yes, sir. Thank you. Thank you, Senator Kennedy. Senator Reid of Rhode Island is recognized.
Thank you very much, Mr. Chairman. Thank you, Chairman Powell, for being here today. We saw in the wake of COVID the globalized supply chain disrupted significantly, and we're in the process, in some respects, of rebuilding a supply chain with an emphasis on sourcing in the United States. To what extent did that disruptive supply chain contribute to inflation, and to what extent will the new, if you envision it, the new supply chain that is located in the United States and other friendly countries affect inflation?
So the initial outbreak of inflation was all about spending on goods where people couldn't spend on services. So goods spending went way up, and the global supply chain, many goods are imported. The global supply chain just collapsed, and that was the source of the original inflation. It has now spread over the last 2 years to housing and also to the rest of the service sector. So to your question, we are seeing goods inflation has been coming down for some time now. It's still too high, but it's coming down. Housing services there's in the pipeline. You see the new leases that are being signed, and what that tells you is that in the next 6 to 12 months, we will see that come down. But this big service sector that's everything else, which is financial services, medical services, travel and leisure, all of those things, that's really where that's the source of the inflation we have now, which had nothing to do with the supply, or not much to do with the supply chains. That's where the challenge is now.
And is there anything that you can do that would target that service area without affecting the other areas?
There's not really. You know, our monetary policy tools are famously powerful but blunt.
A different topic, and that is, as you're probably aware, the Fifth Circuit delivered a ruling in the Community Financial Services Association versus CFPB that the CFPB's funding mechanism is unconstitutional. Just like the Board of Governors, the CFPB is a bureau of the Federal Reserve. Both the Board of Governors and the CFPB rely on the same source of funds and draw on those funds in virtually identical ways. If the Board of Governors funding structure would be found unconstitutional, what would the implications be for the country and monetary policy?
Well, it would be very significant, but I have to say we have significant responsibilities, but I would be reluctant to comment on a case that's before the Supreme Court.
But it is certainly something that you've had people examine for possible ramifications.
Yes, and the central banks tend to be self-funding because of the way they work, and that's a key factor of our independence.
We've gone back and forth on the impact of rate hikes on workers, and you've indicated previously that wages have not been spiraling upwards necessarily, and that inflation expectations are currently stable. But the impact on increased interest rates are usually felt more by low to moderate income people. Is there any way you can work yourself out of that dilemma?
So where we are right now, of course, is very low unemployment. Wages have been moderating, and they've been doing so without a softening in the labor market, without rising unemployment, really, and that's a good thing. So we really don't know. The current situation is a combination of more typical supply and demand issues, but also just things that we haven't seen before, like the war in Ukraine, like the supply chains that you mentioned. Right. So we have many unusual factors, and I don't think anybody knows with confidence how this is going to play out.
Thank you very much, Mr. Chairman. Thank you, Chairman.
Thanks, Senator Reid. Senator Brett, Alabama is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's great to have you here today. Over the past 2 years, we've seen the highest inflation of my lifetime, driving up costs for American families across the board. According to the U.S. Department of Labor, the annual inflation rate in 2021 was 7%, and in 2022, it was 6.5%. According to the U.S. Department of Agriculture, the cost of food went up 10% in 2022. And the real effects of that is moms and dads across this nation that are working to put food on the table for their kids, for their babies, had a harder time doing that. This has devastated hardworking Americans, causing a kitchen table crisis in every corner of our country, as the price of food, energy, and housing have all skyrocketed. In response, the Federal Reserve has raised the Federal Reserve Fund rate more than 4 percentage points. Being far from transient, inflation has remained persistent, high, and well above the Fed's long-run goal of remaining under 2%. In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
So I'd say a couple things to that. First, we're going to be looking at inflation in the 3 sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector. And we need the inflation that's already underway in the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of consumer spending, and more than that of what's currently inflation. So that's one thing we'll be watching that very carefully. Also, we raised rates very quickly last year, and we know that if monetary policy, tightening policy, has delayed effects. It takes a while for the full effects to be seen in economic activity and inflation. So we're watching carefully to see those effects come into play. So we're aware that we haven't seen the full effects yet, and we're taking that into account as we think about rate hikes.
So when you're looking at this, obviously not to get into a policy discussion, but if there were an increase of energy production in this country, do you feel like that would help drive down inflation?
Well, I think over time, more energy would mean lower energy prices. But we are very focused on what we call core inflation, because that is what is driven by, really by demand, and our tools are really aimed at demand.
Right, understood. But I feel like the cost of energy is not just what you pay at the pump. It ends up affecting every good across this great nation. Additionally, I'd like to ask you about labor participation. So when you look at the unemployment rate, and we've heard my colleagues discuss people having to be displaced in order for us to maybe get to the inflation rate that we would like as a nation, I'd like to focus on the labor participation rate. So right now it's 62.4%. If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
I think that it would. I mean, remember those people coming into jobs, yes. That would be great, because the economy clearly wants more people than are currently working. Of course, those people would then spend more, so it wouldn't be a zero-sum game. But it would be great for the country and great for them if they were to come into the labor force.
Amen. I believe that increasing in capital requirements on financial institutions would have a chilling effect on the economy and the availability of financial services. And last week, I joined many of my colleagues in sending you a letter that expressed concerns that if the Federal Reserve decides to conduct a, quote, holistic review of capital standards, as we heard Senator Scott talk about earlier. So is the Federal Reserve concerned that the impact to the economy of increasing capital requirements on financial institutions at a time when inflation remains persistently high would cause an issue?
So I think it's always a balance. We know that higher capital makes banks safer and sounder. We also know that you will at the margin provide less credit the more capital you have to have. But I think it's never exactly clear that you're at the perfect equilibrium, and it's a fair question, I think, to look at that.
And I know out of respect for the chairman and trying to stay in my time, I will just end by saying I heard what you said. Obviously, as you have said, the Federal Reserve is not and will not be a climate policymaker. I just want to thank you for your public statement on that. I agree with you that there's a difference between policymakers and financial regulators, and certainly look forward to working with you in the future.
Thanks, Senator Britt. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Let me start by saying, depending on who's asking questions, we're either pounding you for how quickly we're going to drive that inflation back to 2%, or pounding you on making sure that we don't push the economy into a recession and drive up unemployment. I got to tell you, and it's these are maybe not the cheap seats, but I actually think you've done a pretty good job in terms of both ratcheting up rates and then starting to tail off a little bit. I think we all were concerned by the January numbers where it popped up a little bit more. I wish, Mr. Chairman, we were actually having this hearing 2 weeks from now, because we're going to have a lot more data later in this week and next week. But I want to net, we've still got ways to go, and the January numbers were concerning. But I do think your tailored approach, we can all second guess, but I think it has been the right approach. I'm going to commend you on that. I want to get two questions in. One of the areas that I am very worried about is commercial debt. I mean, we've got a Bloomberg story here showing, we're going to hit a $6 trillion wall this year on refinancing. Where I'm particularly concerned is the issue around commercial real estate. As we recover from COVID, a lot of things are getting back to normal, but clearly the transformation of where people work is going through a fundamental transition, and I hope people do return more to the office, but lots of folks prefer working elsewhere. That's going to fundamentally change the real estate market on the commercial side, and I do believe we're going to hit potentially a cliff here of a totally unexpected problem in terms of commercial real estate. How are you looking at that issue and recognizing there's lots of bumps coming out of COVID? This one seems to be more unique in nature, and how are you thinking about that issue?
So the first one on commercial debt, business debt generally, it's kind of been moving sideways as a percent of GDP, so you don't see a big spike going on or anything like that. However, of course, there are pockets of concern, and particularly you pointed to the refinancing spike that has to happen, and I've seen those come and go before. Generally, markets can absorb them, maybe at a much higher rate this time, but it's something that we're well aware of and watching carefully. In terms of CRE, I would agree with you. The occupancy of office space in many major cities is just remarkably low, and you wonder how that can be. Now, over time, some of that's going to be made into condominiums and things like that, since we don't seem to have quite enough housing in some places. But the question is, what's the financial stability risk? It's not great for the largest institutions. Don't tend to have a lot of direct exposure to that. Some smaller banks actually do. Medium and small size banks do. We carefully monitor it. We agree that that's an area that requires a lot of monitoring, and I'd say we're on the case. So,
well, that will morph me into my last question. Something we've talked about, and a lot of my colleagues have talked about with the large institutions. I do think even some of the biggest critics of Dodd-Frank, I think, would acknowledge our banking system is a heck of a lot stronger and was able to withstand COVID in a very healthy way. But what we've also seen evolve is a vast amount of financial institutions move beyond the regulatory perimeter. The fact that we now have way over half of the mortgage origination coming from non-financing institutions, because a lot of the large entities, hedge funds, other funds that may be doing some of this commercial debt or some of the CRE debt. I'd like you to talk generally in the last 40 seconds or so of how you think about this regulatory perimeter. I'm a big believer, and I know some of my colleagues are, that that we ought to look less at charter and look at same risk, same regulation, maybe as a guiding principle. And I know Senator Warren's been working on some work. I've been working on some work around crypto around that area. But there's a vast amount of activity that's taking place outside the regulatory perimeter. How should we be thinking about that, and how do we make sure that doesn't create the kind of crisis sneak-up that happened in 2008 on the non-regulated side of the House?
I think you articulated the principle very well. It's same activity, same regulation. And that covers crypto and all kinds of other activities. People are going to assume when they deal with something that looks like a money market fund that it has the same regulation as a money market fund or a bank deposit. And so stable coins need some attention in that respect. I just think that's the basic principle. And you're right, so much of intermediation has moved away from the regulated banks really for a long period of time. We got to keep an eye on that.
Thank you, Chair Powell.
We can keep looking at. I hope it's.
Thank you, Senator Vance. I'm sorry, Senator Hagerty of Tennessee.
Thank you, Chairman Brown, and thank you very much, Ranking Member Scott, for holding this hearing. Chairman, it's great to see you again here. I appreciate your presence, and I appreciate the opportunity to talk with you about an item that I'm particularly concerned about, and that's the holistic review that Senator Britt just brought up that Vice Chair Barr is conducting right now. It's generating a sense that higher capital requirements are on the horizon for us. And as I think about that in the context of what we've weathered, you think about the situation in 2020. It was an acute, real-life stress test, if you will. And I think that our financial system navigated that admirably. In the past, Chair Powell, you've told this committee that our financial system has proven resilient through 2020, and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate. And I just wanted to follow up on those prior statements and see if you still feel that way.
So I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. That's what the former one, Vice Chair Quarles did, and that's Dan Tarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation and supervision to the full board. The role of the board is to consider those when made, and this, to me, this just comes under that heading.
Well, as the review is underway, and I appreciate that context, one aspect of it seems to us as an apparent willingness to undo the tailoring requirements that were enacted as part of S2155. And I understand that nothing has been finalized regarding the regulations. It's a concerning prospect if that's the case. The Fed's General Counsel just yesterday alluded to undoing 2155 by, quote, pushing down the Basel requirements on banks that were intentionally given relief in that bill. So I want to be perfectly clear that the banking regulators themselves can't just simply ignore or selectively enforce the laws. And again, I realize that the details of the study haven't been finalized and made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S2155, will you vote for it?
I can't answer that in the abstract, of course, but I would say we're, as an institution, very strongly committed to tailoring, and anything we do is going to reflect, tailoring of institutions according to their risk, and I mean that's a principle that we'll stick with.
I think it's quite important, again, given the legislative intent here and the concerns that we maintain that in the face of what General Counsel said just yesterday. I appreciate your perspective in terms of keeping that in place. I'd like to come with my next question, Chairman Powell, with starting the question by underscoring the importance of the independence of the Fed's monetary policy. Right now, the economic picture is about as uncertain as I can remember. We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we got a very strong reading on inflation in January, also a very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So inflation's running at, core inflation's running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Indeed, it suggests that we still have work to do.
In that context, thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our assessments, individual assessments of that in December, and I think the median range was, basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Got it. Thank you, Mr. Chairman.
Thank you.
Thank you.
Thank you, Mr. Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very
Just
very
looking
infrequent.
at the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this, and
There have been 12 times that we've seen a 1-point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest. Don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that, but I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families, and if you're not going to lead that charge, we need someone at the Fed who will.
Senator Vance of Ohio.
Thank you, Mr. Chairman. Chairman Powell, thanks so much for being here. I have a question that's slightly far afield, but how often do you get to talk to the Federal Reserve Chairman, so I might as well ask it. So to give some context here, my family comes from Appalachia. Particularly my grandparents grew up in southeastern Kentucky, coal country, and then moved to southern Ohio, where I now have the honor of representing all of Ohio. And one of the things that you hear a lot when you study the regional history of Appalachia is it's often described as possessing a resource curse, right? So there's a lot of coal in central Appalachia that enables a certain amount of consumption. Obviously, consumption is good. People need food and medicine and other things. But there's also a pretty good argument that for a host of reasons, it causes malinvestment in the region, and consequently, you have lower productivity growth, lower innovation, and an economy that's much less diversified and much less dynamic. I'm wondering, when I hear about the history, when I think about and read about the history of Appalachia and the resource curse, I'm struck by by the idea that you could make a similar argument about the reserve currency status of the United States dollar. Americans have enjoyed one of the greatest privileges of the international economy for the last nearly 8 decades, a strong dollar that acts, of course, as the world's reserve currency. You know that better than I do. Now, this has obviously been great for American purchasing power. We enjoy cheaper imports. Americans, when they travel abroad, benefit from lower costs. But it does come at a cost to American producers. I think in some ways you can argue that the reserve currency status is a massive subsidy to American consumers, but a massive tax on American producers. Now, I know the strong dollar is sort of a sacred cow of the Washington consensus, but when I survey the American economy and I see our mass consumption of mostly useless imports on the one hand and our hollowed out industrial base on the other hand, I wonder if the reserve currency status also has some downsides and not just some upsides as well. And let me just put a final point on this, and I'd love to get your thoughts on that, Chairman Powell. We're, of course, now the main supporter of a massive land war in Europe between the Russians and the Ukrainians. I read recently, and I'm not going to comment on how perfect or precise these estimates are, but I read recently that the United States is trying to ramp up production from 14,000 artillery shells to 20,000 artillery shells. That's per month, while the Russians are firing 20,000 artillery shells in Ukraine per day. And when I look at the American economy, we have a lot of financial engineers and a lot of diversity consultants. We don't have a lot of people making things. And I worry that the reserve currency status and the lack of control we have over our currency is perhaps driving that. I'd love to get your feedback on that. What are the upsides and downsides of the reserve currency?
That's a big question to try to answer.
You have 2 minutes, today. Chairman Powell, so plenty of time.
I can't even get started on that. So we are the world's reserve currency, of course, and that's because of our democratic institutions. It's because of our control over inflation over many, many, many years. The world trusts the rule of law in the United States, and those are the things. So once you're the world's reserve currency, it's used all over the world in transactions, and it's